Open Market is sponsored by AdLib, the self-serve DSP solution making advertising easy. What do the world's largest demand-side platforms have in common? They're effective, but they require large annual contracts and spend minimums. With AdLib, growing agencies get a single platform that connects to every top global DSP with no contracts, no spend minimums, and G2's #1 ranked support. That means access to the entire universe of TV, digital out-of-home, audio, display, video, and native without a hassle and with no blind spots. It's incredibly easy to use, plus it can automate most of the work your team spends hours a day doing manually. Get the most powerful media buying technology without the barriers to entry. Check out AdLib at getadlib.com today.
Welcome to Open Market, a podcast about building companies in the advertising industry. I'm Joe Zappa. I'm joined by Eric Franchi and the master of ad tech mergers and acquisitions and nascent liquor magnate, Terry Kawaja.
Terry, welcome.
Thanks, Eric. Nice to be with you and Joe.
Talk about liquor. Just go straight into it. What are you doing? What are you doing?
So, after Cannes, I proceeded to head to Lake Como in Italy. I was there to support my wife in the final residency requirement of her Italian citizenship application. I'm pleased to report that she is now Italian, as are my kids, and I now have to start the process and become Italian myself. So, Eric Paisano and Joe.
Yeah, this is the Italian-American ad tech pod.
Totally, right? Yeah, it is now. Well, it is soon to be. I'm not yet Italian. I have to pass the test, so I have to be proficient. So I got some studying to do. But here I am, 7 weeks in Lake Como, having a wonderful time in Italy. You know, it was a particularly inspirational time for me creatively. I went crazy. It was writing parody, doing deals, but I was working, just so we're clear. But I wrote a million parodies, and I just had this idea, limoncello. So I contracted with a white label manufacturer. I picked out a bottle, I designed a label, and I had like 8 bottles shipped to me. I tried it. It was good. The bottle was awesome, and I said, "Great, I'm going to be in the limoncello business." And so, of course, I wrote a 30-second spot, and I wrote a parody song, a karaoke parody song for it. And got more made. We've now had it available at 3 different events. It'll be for a good part of the next year, available at select tentpole industry events at the more high-end functions late at night after dinner. Then eventually we'll be moving into commercial applications. So it'll be available for all. But the fun part was the whole preparing all the marketing for it. It says "LUMA, the sweet taste of a premium exit."
Amazing.
Really?
This is going to be a lot of fun. So as the listeners know, as you know, Terry, this is a pod about like building businesses. You know, we have like a strong emphasis on all things GTM. We like to talk about marketing. You're particularly interesting because you're a banker and you're a marketer. And I think oftentimes you look at things from a marketing and content lens. So I think we're going to talk about a bunch of stuff. We'll talk about M&A. We'll talk about marketing. And maybe, Joe, you can kick us off with some of the macro.
Yeah, Terry, as you were talking and I was thinking about your burgeoning liquor venture, I was wondering what role marketing and your inclination for it has played in your career as a banker and in the growth of LUMA over the years.
Let's start with just that, the liquor thing. Think about it, right? Liquor is a commodity, right? It's barely differentiated. They all have the same ingredients. They all taste roughly the same. So the reality is, like, how does Exxon, beat Texaco in terms of selling gas? All gas is the same. It's a commodity. Liquor is largely the same. Yeah, there are minor differences in taste. Yes, fine. I'll grant them that. But the reality is, I'm going to say 99% of what goes into a successful liquor brand versus an unsuccessful liquor brand is the marketing. Sort of exhibit A is the celebrity liquors. I mean, Ryan Reynolds has Aviation Gin, which he sold for $900 million or $700 million, a lot of money. And is it a better gin? I'm going to go ahead and say probably not. Probably it's a perfectly fine gin. And that's really all you have to do is be perfectly fine. And it's not one. I mean, many celebrities have done liquors that have great sales. There's lots of margin in alcohol. And then they sell them to these big liquor. There's three big liquor global conglomerates, and they basically tend to buy up all these brands because they want to splinter the market share. So it's marketing, and so that's an instance where we were talking about a commodity. Now let's flip to my business. I'm going to go ahead and make a controversial statement, and that would be that the provision of intelligent, informed, capable M&A execution is a commodity. I know what I just said. I just said my business is a commodity. What I'm really saying is a major component of my business, the actual processing, the negotiating of the term sheet, the running of a process, the negotiation of a stock purchase agreement, and running of the due diligence to all of those aspects of investment banking, let's face it, are commodities. They require skill, they require experience, but there are hundreds, if not thousands of bankers that I could substitute for me. We do an excellent job of that. We take great pride in our execution excellence, but there's hundreds and thousands more. Where you get differentiated is in the higher levels of the execution. So the game theory, negotiation, and a lot of that depends on relationships and trust that you've built up with the buyers. That's where we differentiate, but also we completely blow our competition away on marketing. And that starts with content marketing, the LUMAscapes to our, we're voracious publishers. We're publishing trends decks. We're publishing market reports showing valuations. We play with our cards facing up. We like the label on the outside. We're being very transparent about how we're thinking about an industry. And, in the early days of this, when I worked for another investment bank, I started doing this. And they said, "What are you doing? You're giving away good IP." And I'm like, "You're confused. I can reach a much larger audience by putting this on social." And by the way, social at the time meant a company called SlideShare, which became a division of LinkedIn. So that's how you shared sort of presentations back in the day. Of course, there's any variety of distribution methods now, including YouTube and social media. So the old banker notion of, well, don't share that, it makes no sense. I can get far better distribution. And I think it also behooves us to look, we have a select group of clients. There's actually, few in number relative to everybody in the ecosystem. And I wanted to, share our views to the broader ecosystem. Yeah, sure, to lay the groundwork of credibility so that we can get deals. But more importantly than that, to give back, to just share perspectives. And I think, that kind of activity, just as you are doing now, Eric and Joe, I mean, look, you're not doing this solely to drive more deal flow and get more PR clients. You're doing this because you want to give back and just share perspectives. And there's a benefit that accrues to your audience and to our viewers of our content that doesn't necessarily mean a benefit to us. So I'm good with that. I enjoy that. Makes me feel good.
You were really early to a lot of the things that we talk about, with respect to marketing and building reputation. This idea of, being prolific with content, being everywhere from a social perspective, having a voice, right? Being, a direct channel to the perspective of the firm. Joe, he kind of checks all the boxes that, you hammer every single week, it seems.
Yeah. I mean, as Terry was talking, I was thinking that a way I like to describe marketing, especially to marketing skeptical founders, to simplify it for them, is marketing is about building your reputation and relationships, right? If we do those two things, we're going to drive more pipeline. It's going to be easier to close the deals that we get.
Yeah.
And they're going to be bigger deals on average, right? And I think LUMA has done that very effectively. And as a fellow service business owner, albeit of one less storied than LUMA, I relate to that, right? Like when you first start a service business, you're like, I'm going to differentiate in all these ways, yada, yada, yada. And you realize that from the customer's perspective, they don't live in our world all the time. They're not thinking about investment banking all the time. They're also not thinking about marketing all the time. So to them, the options often do look like commodities. And then how are you going to win? Exactly as you said, Terry, it's that reputation and relationships piece, which brings me to a follow-up question, which is, so we talked about the role that marketing plays for you. Now, Eric was asking me before the pod to ask you, what role does it play for your clients, i.e. the companies who want to get acquired? How does marketing help them have a favorable outcome?
Yeah, it has a huge role. And I've heard the people that poo-poo marketing and they're confused. They just don't understand how important it is. And by the way, I'm not talking about spending a ton of money. I'm talking about concentrated strategic efforts. And I think of this a little differently. There are the usual notions of B2C marketing and B2B marketing, right? So B2C marketing is your company marketing its products and services to consumers. So it's a universe of millions. B2B marketing is different. It's a business selling its goods and services to other businesses. So you're talking thousands or tens of thousands. So it's a fundamentally different channel, and it requires fundamentally different strategies, right? For B2C, you're going to use advertising, among other things. For B2B, advertising doesn't make sense. So you're going to do webinars and white papers and conference events and things like that. Well, I have talked to people about a third type of marketing that I think I invented, at least the term for, and I call it B to D marketing, business to development. So like business to business, the two parties, the marketer and the intended recipient, are both businesses, but instead of marketing your business's products to the other business, you're marketing your business to the other business. And so business to development marketing turns out has a Venn diagram overlap with B2B marketing, because selling your products is a part and parcel of selling the notion of, your company. And so, things like, content marketing and speaking at conferences and networking and meeting people and getting your word out is a component of that, but it's not everything, because what you would want to do is, if we start from the premise that it's better to be bought than sold, and there's a lot to that, and we can get into other aspects of that. But as it relates on the marketing side, you never want to be out there just selling your company. First of all, if nobody knows you, then they're not going to show up. It's the same reason why people with great name recognition do better in politics. Why? Because when you get in that voting booth, oh yeah, a Kennedy, a Trump, I know those names. Unfortunately, a Clinton, and hopefully a Harris. But well beyond name recognition, they need to have a sense of who you are. People in the history of M&A, no acquirer has ever bought a company that they've never heard of. It's never happened, right? So familiarity, it starts with familiarity, and then they get sort of equity in your story, and they understand it, build a relationship. And so we describe B to D marketing. And by the way, I'm not talking about just M&A. It could be partnerships or business development deals that you do. But again, you need to get together, you get to know these people, and there's very fewer in numbers. In fact, the total number for any company that could be a counterparty on doing business or corporate development is probably enumerated in less than 100 people. They tend not to aggregate very often, which is why we constructed our digital media summit in a way that basically aggregates all the buyers, financial sponsors, all the strategics across the board, and then the CEOs, because when you get them together, that's a perfect opportunity to do B to D marketing.
You don't need to name names, but maybe you should name names. Can you think of, in your past decade or so of doing this at LUMA, a company that was so good from the marketing perspective, or a CEO that was so good from a marketing perspective that it made a deal get hotter when the deal sort of started to come together? Or conversely, a company that maybe under optimized their outcome because they were not as good at marketing?
One name that comes to mind is Jonah Goodhart and Moat. It kind of makes sense that someone with a tool that helped with brand marketing recognition is good at brand marketing recognition. So that's logical. But Jonah is a consummate pro, and not in a very understated way. I mean, he sort of does it. He sort of earns it, right? If you recall back in the day, Moat would sponsor events. They had this wonderful event out in the Hamptons that brought together, very high level people. So they did it with exclusivity, and they went, sort of high end. But that was just one aspect of it. They sponsored conferences in a way where they were ensuring they could get their thought leadership out there. And quite frankly, they were early to a category. They kind of helped create a category. And if you think about it, that's a hell of a category. He sold for $850 million to Oracle, but he also, that's DV and IAS, and those are now, if you add up the accumulated market caps of all those businesses, it's just shy of $10 billion. So they did a lot in the category, and I think Jonah was early as a thought leader to sort of, it was missionary. It's missionary marketing, because you're trying to teach people about the need for the category and then why yours is differentiated. So it was almost like a double-barreled challenge from a marketing standpoint. And I will tell you that exit at 15 and a half times net revenue, as I recall, it was a good business. It was a growing business, but I mean, 15 times for a scale business, is an extraordinary, 1% outcome. And I think in good part, it was a function of the tremendous, reputational work that Jonah and his team had been doing for years.
I love the way you put it so simply when you said you can't get acquired if no one's heard of you, right? They're not going to be looking for you if they don't know you exist. That's something I find myself saying all the time, especially to early stage startup founders, because they're often technical and dubious in marketing. And, I've had them say well, they just don't get the fundamental proposition, or they're like, well, we do one-on-one sales. It's like, yeah, but you're going to get more sales if people have heard of you and if they know about you before you reach out.
So I argue the same thing. And I tell everybody, I said, I'll sit with a company, and this is something that happens with frequency. I'll sit with a company, they'll describe what they're doing in market. It's a better mousetrap. Let's just call it a better mousetrap, whether it's an identity solution or something. I'm like, wow. And they talk about their traction and they're doing great. I'm like, great. I said, guys, you have totally effed up. They're like, well, what do you mean? I said, nobody knows about this. Why am I, a guy who spends all of his time in this space, why am I only learning about this now? Why did I not know about you? And the world doesn't know about you. So, it's always better to lead with actual product and then follow with marketing. But not having any marketing, I said, it isn't going to do you any good to have this wonderful stuff if nobody knows about it. So, and I find there's a tendency, Israeli companies are a perfect example of how that happened. The Israelis, they just don't understand marketing, or they don't value it, I'm like, guys, you suck at marketing. And when they're like, you know what, you're right, and we should do something about it, because you do want to be in market, but then you don't want the marketing to fall too far behind. And look, I'm like, you're making my job, if I'm to represent you in a potential exit, it's so much harder if people don't know. And by the way, I can self-reference to demonstrate this point. I said the LUMA tapes have been viewed over 17 million times by every country in the world. We have the log file of the IP address where they came from. There's 2 nations on this globe that have not viewed and downloaded a LUMAscape: North Korea and the Democratic Republic of the Congo, which is decidedly undemocratic. There used to be 3. It used to be Syria, but you won't believe this. About 4 years ago, someone from Aleppo, someone in Aleppo, I mean, bombs are falling, and someone, what a nerd, is downloading a goddamn LUMAscape. So if that doesn't demonstrate and by the way, like, zero cost. I have not spent a penny to market the LUMAscape. They just propagated. And so to what I say to early stage founders who are skeptical, Joe, your term, for somehow they view marketing, it's like, don't think of it as, funneling a ton of your scarce capital that you need for your burning business. Just be smart about it. There are many things you can do that are either no cost or low cost, and you want to get some momentum before you even start adding, fuel to the fire. But marketing, to all the entrepreneurs listening, it's not essential, it's existential.
I think the hesitance you describe and the stereotype about the Israeli startups is a common one in the industry. And in my experience, there is a lot of truth to that. Yeah, I think it's because some people have a contrast in their minds between operations and execution on the one hand and marketing on the other. They're like, oh, well, that's just cloud chasing, or like I'm trying to get attention, as if it's a negative thing, right? And you're like an attention whore. It's like, no, there's no distinction. Like there's no contrast or like demarcating line between marketing on the one hand and sales on the other. Marketing fuels sales. That helps grow the company. And we can all agree that that's a good thing.
100%. The line I frequently tell people, which tends to misdirect and throw them off, is, look, the world is divided into two things. There's reality and there's perception. There's only one that matters: perception.
Yeah. Yeah. But before we jump into the M&A stuff, one more question on the marketing side. What role does a CEO's voice play in your world of M&A? So it's like CEO reputation, CEO voice, company reputation, company voice. And, how do you advise CEOs and founders accordingly?
So both are important. The CEO is critical. The CEO is the CMO, if you think about it, right? You want a CMO entitled to actually be managing all the campaigns. But if you think about it, especially for early stage companies, the personality, the credibility, the authenticity of the CEO, it's hard to separate it from the company. Now, as you scale, you also want to demonstrate that you have a deep bench. So it's really good to have other C-suite executives on stages talking, being seen as credible, so that, it doesn't look like a one-man show. It tends to start off as a one-man show, and then it becomes a team sport.
Yeah, I love that, Terry. The way I tend to put it is the CEO is the chief evangelist, and they'll be seen as the chief spokesperson for the company no matter what. So sometimes you have like press shy CEOs, and it is part of the job of the marketing team to try to help them get out there, because if they're silent, you're just not leveraging a huge advantage that you have, because people want to know what the CEO has to say. So if the CEO says it on LinkedIn, for example, it's almost always going to generate more attention than if like a director of marketing is saying it. So it's the job of that director of marketing to enable the CEO to get out there and evangelize the company.
And look, you're right, evangelizing. But I think it actually it's even deeper than that. It's values, right? I mean, what does a brand stand for? I would tell you that LUMA's brand stands for deep knowledge. It stands for objective credibility. By the way, in a group of cohorts that lack credibility in the sense that they're out there shilling for their client. I want to represent my client to the best ability, but we built an objective credibility that is different from other banks. But I would also say irreverence. LUMA, we don't take ourselves too seriously. And, so those three things, I'm going to go ahead and say, is there any separation between Terry and LUMA? No. And there shouldn't be, right? I mean, you should leverage that to the benefit of the company.
Speaking of that deep knowledge, what do a lot of people in the industry get wrong about acquisitions?
That's its own podcast. So let's step back. Let's say we have an entrepreneur, and they're a brilliant technologist. They had a vision. They had an idea that was ahead of the market, and well done, right? 3 to 5 years before it became a thing, they said, you know what? I think this is going to become a thing, and they start building towards it. So, like a case in point, like if you hear about curation now, well, everybody and their sister's getting into curation or AI. Who got into it 5 years ago in anticipation of this? Because anyway. So whoever can do that is a very smart person. They know their space well. I'm going to go ahead and guess that they haven't done a lot of M&A. I mean, sometimes you'll get someone who's a 3-time, 4-time founder, and they've had several exits, so they have some experience. But when I talk to a founder who says, "Well, I've sold two companies, so." I've got to go to handle them. I'm like, really? I've sold 427 companies. So yeah. So let's I mean, look, you have good experience. You have some. You've at least tasted it. You sort of know what it. Couple of examples, but I mean, it's not even close. I've been doing this for 35 years. It's second nature, and so it's a rare event, M&A. And it's probably the single most important event of your life, your career, so it's a dramatic, if you think of it as a lifetime value, is very high, if we're going to put it in advertising terms. And the fact that, it's so important, and the fact that they don't know anything about how this is done. They tend to, and I see a pattern recognition here. These are smart people, so they tend to say, "Well, I can do it, right? I can figure it out, and blah blah blah. I'll handle it." And in some instances, it does work out, but more often than not, they all fall into the same traps that we've seen time and time and time again. So I like to, when I see a company that I like in the early days, I will start giving them free advice just to say, hey, bear in mind a few things. And some of the traps that they fall into is they just don't appreciate the implications of their financing strategy. And by that, I mean, if you think of an end game here, your return of your investment, and Eric would know this well as an active investor, there are only three variables. That's it. There's the numerator, how much you sell for, exit for, the denominator, how much you put into it, and time, T, how long it takes from between one and the other. That's it, folks. Those are the only variables that exist that determine your DPI, your return on your investments. And so, as it turns out, you can hopefully influence the numerator, the price you get, but I mean, a lot of that's exogenous. Someone else has to decide something to pay. You don't get to dictate your exit price. Timing, well, we'll come back to timing in a second. But the one you could have absolute control over is the denominator, is how much it requires of funding in order to get there. And, I've talked to companies who maybe they have a great mousetrap. They have a good idea. It's all great. I'll go without names and say to this one, it was a guy who was contemplating taking the CEO role at a company. And it was a very interesting company. It's thought of as, that's a winner. That's a very interesting company. He said, so do you think I should take the job? And I said, well, I think you should think about, is what we do, which again, let's agree is something differentiated, something that is deemed to be, useful, given where the market's going, in time, call it 3 to 5 years from now, is that capability a feature, a product, or a company? And the reason I say that is I could foresee a future where you're trying to make it a company. Some other business could establish it as a product, and other bigger companies, platform companies, could just give it away as a feature. And we have seen this in the marketing technology space in particular, time and time again. You build a certain capability, which no one would argue is not warranted or relevant. It's just that the bigger companies will say, yeah, fine, but I make so much money in infrastructure or these other products, I'm just going to give that away. In which case, I would argue that that has a great potential in this instance. And so that means that the only logical exit for you is if one of the latecomers of the big guys says, okay, these guys are giving away, they built a business, I need mine, and I need to accelerate my time to market. I don't have time to, stand up a team of 50 engineers and build this thing, which will take 3 to 5 years with a 50% chance that we get it right. No, I need to just buy a company. That's a small universe of potential buyers, and it gets smaller and smaller the more capital you raise. So I said, by all means, take the job, but whatever you do, don't raise too much capital. And lo and behold, they raised a shit ton of capital. And again, the implications of raising a shit ton of capital. And by the way, raising a round, you do a $20 million Series A and a $50 million Series B. These are all indicia of success. But I would argue, be careful that they may be false positives, in the sense that all you're doing now, if you've raised now $100 million, you now have to sell for do the math. You got to sell for $700 million because they came in at a valuation. They want 3x in their mind. Like when you do the math, all of a sudden you're like, okay, we always advise companies to think about the optionality and local maximums along the way. What do I mean by that? I mean, if you've just done a seed round, you could sell for $25 million and have a great exit, meaningful wealth for the founders and early investors. Once you do a Series A, you kind of got to sell for like 100 to 200 million. Well, you do a Series B, now you're in the 300 to 500 range. And if you do a series that you keep going, and now you need $1 billion exit or a multi-billion dollar exit, and do the math, the acquirers and their capability, what they're willing to spend, it just dwindles and dwindles. So when the buyer universe shrinks, it makes it very, very difficult to do an exit. I am talking about companies that most likely their exit is a trade sale as opposed to an IPO. The way ad tech works, because of the interworkings and the API functionality of all of the different products, it tends to be trade sale.
When we talk about trade sales, I just want to ask a very tactical question, but this changes over time. What's the sweet spot for ad tech exits? I remember we were talking at some point, and you threw out, this is probably a few years ago, like 150 to 350 is the sweet spot for strategic exits. Is it still around that? Has it expanded or contracted at all?
I would drop it to 100, and 350, 400, so somewhere in that range. Fortunately, we're averaging towards the higher end of that range because we'll do a $100 million deal, but we prefer, and bigger is better, it turns out. And by the way, it's kind of straightforward math, right? If you're a large company, what is your alternative? Every time a company buys or considers buying another company, it's in the context of build, partner, or buy. And, you can stand up a team over 3 years. You do the math, and you just can't get to that much more value.
Yeah, optionality being the key word then.
Yep.
You posted this week, Terry, about the juxtaposition between ad tech multiples and MarTech SaaS multiples. I think as you referenced in your post, the dominant thinking in business remains that, SaaS companies get these crazy valuations, and we want to be SaaS. We don't want to be, services or like ad tech, which people often like think about services when they're thinking about ad tech. How does that stack up nowadays?
Yeah. So again, it is historically true that contractually reoccurring business models, that is to say, SaaS software where the business will sell its services usually on a per seat basis, and a contract that lasts 1 to 3 years. Nielsen has 9-year contracts. I don't know how they do it. I guess monopoly. So it's deemed to be, that's higher quality revenue. And of course, SaaS businesses tend to have extremely high, like 80 to 90% gross margins. So it's sort of, you build it once, sell it many times. It's contractually recurring. So they're afforded high multiples. And historically, if you go back 10 years, they actually traded at high single-digit multiples of net revenue, and then crept into double-digit multiples of net revenue in the 2018, 19, 20, 21 period. That obviously came crashing down in 2022. And I think what also crashed with it in the post-pandemic environment, when these companies with this, guaranteed revenue, it only goes up, found out that no, when the contract is up for renewal, either, companies just said, not only am I not accepting your price increase, because that's the usual way, you hook them and then you get them beholden to you, and then you increase prices. No, they said, in fact, prices are going down. Or, you know what? No, fine. We're just getting rid of it altogether. We'll manage. We'll figure it out. And from mid 2022, when we had that tech market crash, and basically the market said to all these companies, stop with your, growth at all costs mentality. You have to be, have to focus on profitability. And that's where I, put on my EBITDA hat. It's very important to run profitable businesses. And they basically, people started cutting spend on, not unnecessary software, but just sort of like on the margin. Well, we don't need this. We'll make do. And so they learned a very hard lesson. And that is that, SaaS is perhaps not as reliable as they had thought. And then here's old ad tech, that long suffered materially lower multiples relative to those fancy West Coast SaaS guys. And it goes chugging along. I mean, other than a crazy period in 2021, when the average public ad tech company had a 27 times net revenue multiple. I mean, come on, that's crazy. And we live in a world now where, as it turns out, usage-based models, advertising has not gone down. It only goes up. Question is it going to go up by a lot or up by less than a lot? But it keeps going up. And so usage-based models, guess what? Revenue is up, growth is up. Public ad tech companies are hitting their numbers. 93% of the 24 cohort of public ad tech companies meet or beat their numbers over the course of the last 2 years. So turns out we live in a world today where those two businesses from a net revenue multiple perspective are right on top of each other. Actually, in the last couple of quarters, ad tech actually is better than MarTech, because here's what happened. Everyone started cutting those SaaS contracts. And so growth of MarTech was slower to slow down. Ad tech plummeted in 22 and to 23 when people pulled back, but now is, picking growth is coming back faster because it's a more agile business model. When it's usage-based, it goes down faster, it goes up faster, whereas the SaaS contracts came down slower, but they're slower to build back up and arguably may not necessarily go back up at the same pace. So currently, as we sit here today, ad tech net revenue multiples higher than SaaS software MarTech multiples.
What are ad tech companies selling for? And I realize like the exit environment has been a little bit quieter and it's picking up. Like, what is the multiple of a trade sale these days?
So, well, just to put it in context, 2023 was over a decade-long lull in M&A activity. Why? It was a function of a variety of things, from the crazy macro variables, the jacking interest rates, and the, quite frankly, fear of a recession. And let's think about it. All of these companies, to the here previously, mentioned sort of new emphasis on profitability, they all started, getting religion, improving their bottom lines, being internally focused. By the way, another variable, government scrutiny, right? All this antitrust enforcement and deal blockages, and quite frankly, put a pall on the market. So there was a whole variety of reasons why 2023, plummeted, and it's now coming back. Strategics are back at the table because what did they do? They all improved their profitability in anticipation of a recession that never came.
Yeah, they messed on
M&A. It's not coming. And what's digital ad spend growth? 14%. Brian Weezer's got it projected another 14% next year. So we're doing just fine. And these companies you can't cut your way to growth. So all of a sudden and by the way, and now we're in a better environment on macro. Inflation is tame. We got rates coming down, and people are looking at 2025 going, oh, okay, I got growth and I got a better business environment. I better dust off those acquisition plans that have effectively been on hold for 2 years and see how we can position ourselves for any number of the key sort of green shoot areas around, identity, CTV, commerce media, or AI. And so they're all doing that now. It feels like it's just all happening at once. So dialogue has picked up massively. This has been a recovery year. So we sort of characterize 2023 was survive, 2024 revive, 2025 thrive, at least, knock on wood, I'm hoping. You asked about valuations. There is no market valuation. I would, and by the way, every deal is different, but if I had to bucket it, I'd give 2 buckets. So bucket number 1 is rationalization and consolidation deals. So that would be 2 second-tier SSPs merging to become bigger. And by the way, good that they're doing that, because that's better than before. But it's not anything to write home about. Like, is it not like all of a sudden, ta-da, they have Meta's business? No, it doesn't quite work that way. There's a lot. The preponderance of deals are in that sort of rationalization and consolidation, and those are not huge valuations. They tend to be EBITDA multiples, and in the sort of mid-single to high single-digit multiples of EBITDA. It's a function. The EBITDA multiple will be a function of growth. The high growth, 12 times, low growth, no growth, 5 times. And if I had to bookend them, You've got, let's say like a Teads went for 5 times EBITDA, 5 times, declining top line. So what do you get when you're declining top line? 5 times EBITDA. Now, it turns out they had 5 times of EBITDA in debt at the parent company. So it was barely deleveraging, if deleveraging at all, for Altice, their parent. And then you can get higher, with higher growth. So that's one bucket. But then you've got the strategic bucket. We have not seen a lot of that. I would give as examples Walmart Vizio, LiveRamp Habu, or Double Verify Sybids, where those were, at least in 2 of those cases, the first and the third, double-digit multiples of net revenue. So now you tend to talk about those companies and net revenue multiples. Now, why is that? Well, why is one an EBITDA multiple and the other a net revenue multiple? It's largely a function of the gestation of the target company. Abu and Sybids in particular were not mature companies. They didn't have a ton of EBITDA. And so, they tend to be done on the basis of net revenue. In fact, I would argue there are 3 phases of gestation and different valuations for each. The first, for nascent companies or relatively young companies, it's just an absolute value. It's not a multiple of anything. So, if I've sold many businesses at, teens to 20 times net revenue. Now, I'll argue that no buyer sits down and says, I'm going to pay 20 times net revenue for this business. No, they'll decide to pay 150 or 300 million for it because they view that as a fair price relative to the value they will create with that acquisition and that technology in-house. It just so happens that it's division and the multiple is an output. And then when they get slightly bigger, then you get the revenue multiples. And then when they get mature, you get to EBITDA multiples.
That was extremely educational. Thanks. I think the audience is going to love that because these are the things I think founders often wonder about, but there isn't like a ton of public information other than, of course, what you're putting out. Last, maybe fun question. So you've been doing this for, 20 years or so. What is the weirdest or zaniest behavior or stunt you've encountered during M&A processes?
Oh, you know what? I'll do this without names. So it was not that distant. So in the last 5 years, I did a deal valued at several $100 million. It was a strategic exit. It was the strangest roller coaster ride. I've been on strange roller coaster rides all over my career where, buyers get swapped out and all kinds of stuff. But this one really took the cake. They were a young, growing business. They got inbound from a big company that you all know well. And they said, no, we're not going to sell to them. I'm like, okay. I'm always telling my founders, no is the most powerful word in the English language. It's a beautiful word to use in negotiation. No. And it was like a time pressure. So there was like an exploding term sheet. And my client said, yeah, let it expire. I'm like, beautiful. I love a client that has, viewing things with optionality. So we did just that, but I suspected something else was going on because we were in exclusive. We were in a 30-day exclusive at a really nice price for this business, a well into double-digit multiple of net revenue. But they had conviction to say no, and so I suspected that they were maybe skirting the exclusivity a little bit and having other conversations. And lo and behold, one of the problems we had with that first buyer is we discovered the company had a ROFR with another business that they had a contract with. And a right of first refusal from another company was really problematic. So we were like, oh my God, you got a ROFR. You didn't even find it. We found it in diligence. So we had to work to get rid of the ROFR. And by the way, that's a difficult thing to do, to get people to unilaterally, cede their rights. So it required a lot of effort. We finally got there. So we got the term sheet and then we said no. The day after the exclusivity expired, another company, whom you know well, came in with a much higher offer. And I said, okay, I get it. We knew this company, this second company, and we said to our client, just so you know, we've dealt with them many times. They've walked away from term sheets left, right, and center. So careful. If you're pursuing a deal with them, we know them. They're good people, but they tend to treat this term sheets as pretty loose. So they said, yeah, we think we're good with them. So we're working away with buyer number 2, and all of a sudden we discover another ROFR. Oh my God. Only this time, the ROFR is held by buyer number 1. They had a ROFR, which was unbeknownst in the initial negotiation. I said, guys, Jesus Christ. I said, is there any more? I mean, what should we know? Like, you didn't even know these things. So now, we, having terminated our deal with buyer number 1 to go with buyer number 2, we then, in order to proceed with buyer number 2, I have to go back to buyer number 1 and say, yeah, I know we said maybe someday in the future, but you actually have a contract right here, and we need you to say goodbye to that. And that was a challenging, but we got it done. And the minute that ROFR went away, buyer number 2 retraded the deal to the tune of 50%. They cut the price in half. Our guys missed the numbers hugely in the month, by the way. That's a really big warning. You must have momentum in your M&A process. If you have weak numbers, you're screwed. So timing of when you do that, very, very important. Buyer number 1 was like, well, why are we signing off on a ROFR? You're not selling like business, are you? Oh my God. So we get that signed off. Buyer number 2 then retrades. And remember, our client, who was a very strong personality, basically adopted the Elon Musk approach to buyer number 1. He said, tell them to go fuck themselves. And I said, no, I'm not going to do that. First of all, that's not professional, and I'm not going to do that. They did nothing wrong. And so I preserved the relationship with buyer number 1. And thank God we did, because we had to then go back to buyer number 1 and say, hey, how about we get together after all? They're like, really? And I said, what can I tell you? They looked at the numbers. They too came in at around 50, 60% of the prior valuation because the numbers had cratered. And we negotiated that back up to a big number again and closed the deal. Oh my God. I died 1,000 deaths on that one.
So they just should have said yes in the very beginning. You basically ended up where they started.
We ended up where we started. It was a headstrong founder who, this is a warning. Like, so we told him, yeah, I wouldn't do that. And he was like, well, what do you know? And type of attitude. And so we were proven right the first time. And then, he said, go tell him to screw up. I said, no, I won't do that. Proven right the second. And I'm like, by the way, Mr. Founder, who's never done an exit before, has this not occurred to you that, we do this for a day job? This is what we do every day for the last 30 years. We know what we're doing. And at the closing dinner, he finally acknowledged. He said, you know what? He said, as I thought about this dinner and thought about like what transpired, he goes, I want to apologize. I was such an asshole. He said, you were right all along, and I dismissed you, and how stupid of me. He was that close to firing us. And I said, you got it all wrong. And look, I've been there before where I've been fired by someone who made a bad decision when I was making a recommendation. And it's not nice for anybody, but it's probably, I'll get over it. It's probably really bad for the CEO who will later come to the realization I so screwed up, and it largely hurt me.
Yeah, when you were giving that answer, Terry, I was thinking this is just a long advertisement for getting someone who has expertise in banking, and then also someone who knows the space, because you also know like who the players are and sort of what their tendencies are, and you have experience, especially in as tight-knit an industry as ad tech.
Well, this goes to a broader thing of just experts. So it's like, if you're going to do marketing, you want to understand how to manage comms. There are people that do this for a living. Like, it may seem expensive. It's not. Not relative to getting it wrong. Like the delta between the outcomes of the two, that's important to build your business. But I mean, it kills me when you get your one time to do the exit, the single most important thing. And people say, I alone can do this. It's like, okay, good luck to you. And so, what we tell people is we spend all of our time out there building objective credibility and trust. We get to lend that to you when we represent you, for a period of time. And why not do that? But yeah, it's okay. It's a free country. It's America.
Well said. Terry, this has been awesome. Thank you so much for your time and your stories and your insights.
Great to chat with you too.
Joe, you want to take us home?
Yeah. Subscribe, like us, follow us, do all of the things so you can get more great content. Terry, thank you so much, everyone. Lumacello coming to a shelf near you.
That's right, baby.
Bye-bye, everybody.